Well, hey everyone. Brian Zeke here from Surf City Financial Group. I want to welcome you all, whoever's out there watching. I want to welcome you all to our very first edition of Financial Wellness Wednesday. We're going to be doing this probably twice a month. We're going to be hitting different topics, whether it be around retirement planning, financial concepts. We'll have some interviews along the way, some guest speakers along the way. So we're going to be doing this for a while. So I hope you and the biggest thing is we want to get some good information out there for you. And we hope you find this somewhat interesting. Excuse any flubs along the way. We're getting used to this software and everything. But I think we'll be fine. So why don't we get started so I don't keep you here all day? We're going to try to make this short and to the point. So let me share my screen with you and what I have to say, talk about today. All right. So this is our topic for today. For financial wellness, our initial Financial Wellness Wednesday, and what benefits should you look for in a savings vehicle? So now there's all kinds of different saving vehicles, and I mean, even among savings vehicles, there's different versions of it. As I go through these savings vehicles, you see what I'm talking about. So let's see. Let me get this bad boy running here. All right. First of all, there's no such thing as a perfect financial vehicle, just not out there. But there's some, and even within these financial vehicles, there are some better than others. I always say I don't believe with a few exceptions, I don't believe there's horrible, bad financial vehicles. I think they should be placed based on what any individual's needs are. But there are pros and cons to each one of them and where you want to put your money. Okay, what are we looking for? What account benefits should you really be looking for? All right, first of all, I would say we want tax deferred growth. Everybody likes that. Nobody likes paying taxes as your money's growing inside a financial vehicle. Ideally, we all like tax-free distribution. Of course, we want a competitive return, although I think too much is made out of rates of return. I think we get hung up on that. If you find a really good savings vehicle, don't you want to be able to put a lot into it as much as you can? We like deductible contribution. In other words, you're putting in, you're getting a tax deduction on it. Collateral opportunities. Now, when I'm talking about collateral opportunities, I'm talking about where you can actually use this account to leverage to take out a loan, right? For instance, this is how if you look at your house as a financial vehicle, which I always call your house is more of a lifestyle decision, but you are typically using other people's money to buy that house. So you are actually collateralizing the house to get the money to pay for the house, right? In some cases, you can actually go to, say, a lender, and I got this much money in this account. Will you loan me? And you can put a lien on a part of it. And that way, the beauty of that is your account continues to grow without having to take a withdrawal. So, for instance, if your account's making 6% and your loan is only 3%, why would you want to take out, if you've got a $100,000 account and you only need $20,000, why would you withdraw $20,000, break down your compounding when you can get it for 2%? So it just makes sense. So that's why you want to collateralize if at all possible. Safe, of course, we all like safety. No loss provision. Would it be nice if you had an account that can't go backwards, that can never take a loss? Guaranteed loan option. That kind of ties in that collateral opportunity, right? So, for instance, if I can collateralize this financial vehicle, the money in this financial vehicle, where can I guaranteed get a loan? In some cases you can, some cases you can't. It, again, back to the house, there's no guarantee. Even if you're doing like an equity line in your house, there's no guarantee you're going to get that loan. So that's what I'm talking about, having a guaranteed loan option. If I want to collateralize this, I get to collateralize it. Unstructured loan payments. Well, wouldn't that be nice, right? Because most loans, there are exceptions out there where you can pay it back as you want to, if you want to. Because example, any other loan, if you take an equity line out in your house and you don't make that payment, you are now going to lose your house. So, and that's where the unstructured loan payments really come in handy. And liquidity use and control. Not all vehicles do you have access to your money. So there are barriers there. An ideal situation is you have liquidity use and control of your money when you want to. And of course, any other additional benefits you could possibly have. So let me close this out. All right. Okay, let's get started. The first one is going to be savings account and or money market accounts, right? Savings account, your traditional savings account, and some savings accounts are money market accounts. And as you can see by the highlighted blue, this is what these accounts offer you. There is no tax deferred growth. You see the first three there, you're not getting no, but you can put as much into it as you want. You actually could, if you have a savings account or money market account, you can go to the bank and say, hey, can I collateralize this but enable basically lock up that part, and then you can get a loan. But you say it's not unstructured and it's not guaranteed. It is, again, these accounts are safe and you're not going to lose money in them, and they are completely liquid. You can get to your money anytime you want to. CDs. Again, no tax deferred growth, because obviously if you have a CD making 2%, and at the end of the year, you're going to get a 1099 off of that 2% you earned. So you're going to lose some of that growth, basically. But you can put a lot of money into them. No deductible contributions. Unless you get a CD inside an IRA, then I guess I can make that case. But traditionally, CD is no. Again, you do have the collateral opportunities with the bank, for instance, is safe, and you're not going to lose money in them. You're not going to make a lot of money in them, but you're going to lose money in them. Real estate and real estate equity, and then maybe with a HELOC. Now, real estate does offer tax deferred growth, right? You're not paying, outside of like real estate taxes and things like that, but you're not paying taxes on the growth. Say your real estate's going up at 3 to 4% a year, you're not paying taxes on the growth side as it grows. But when you sell it, there is potential taxes. Excuse me. Let me get that thing out of the way here. Sorry about that. Don't love it when things pop up. And obviously you get the high contributions, you get deductible. You can collateralize it, obviously, because it's a HELOC, right? You're using a piece of property and they basically, and it doesn't, and that's the other thing, it does not affect the value of the property, and you can get a loan against it. But we know real estate can lose money, so all that stuff's by the wayside. It is not a guaranteed loan option. There are no unstructured loan payments, because if you don't make that payment, they are going to come get that property. Obviously, it's not totally liquid. Real estate is not a liquid vehicle. And, obviously you don't have any other benefits. So basically real estate's good, but, do know what it does here. Margin account on a stock portfolio. I mean, this can be a good saving vehicle, and you can get, as you see, you're not going to get the tax deferred growth because always remember when you have an investment account that's not inside a 401k, an IRA, Roth IRA, things like that, you are going to get taxed on the growth. Now, one thing I always try to point out to people, when that vehicle grows, if you were to pay the taxes out of that, your vehicle would grow a lot slower. Your margin, your investment account would grow a lot slower, but typically we pay it out our lifestyle at the end of the year with our taxes. But you will get a competitive return. You can put as much money in as you can. And again, you can collateralize it. And a lot of margin accounts do come with a guaranteed loan option. And obviously liquidity and use control. So you got a lot of benefits in a margin account. Although one of the things when you have a loan out in a margin account, you have to be careful of if that account drops, you might get a margin call, meaning you're going to have to settle that loan up. So that's things you really need to think about with this. And then obviously you get into rates and things like that. But so this one a little bit more, right? 401k and qualified plans, obviously, there's your IRAs and things like that, and 401k, and you do get the tax deferred growth, but there's no tax-free distribution. Uncle Sam's waiting for their piece when you start taking that money out. You will get a competitive return. You can't get high contributions because there are limitations to how much you can put into a 401k and especially an IRA or even a Roth IRA. So there are, some limitations. As much as you might love this account, but there's no safety, there's no loss provision. There's a little bit of safety with a 401k in the sense that it's got a little more creditor, it's a little more creditor proof, but that's about it. Guaranteed loan options. Now, let me say this, in IRAs, no, there are some 401ks, and that is dependent on who put the plan together, that they're guaranteed loan options, but there are, but I usually don't add that into this because when we're talking about qualified plans, we're talking about IRAs as well and other types of qualified plans like SEPs and all that other thing, solos. Most of those do not, and even the defined benefit plan do not have loan options. Now, some 401ks do offer it. Now, there's problems, I might add, with the loan option of 401k. First of all, you're limited to about 50K. And so you can have $1 million in there, and the most you're going to get is 50K. The other thing is, they actually, to me, the biggest thing you want to think about is you end up paying Social Security a couple extra times, put money in this thing. But the other thing is you're paying back a tax deferred money with after-tax dollars. So to me, that's kind of a bit of a problem. So, it's great to have it in emergency. Not my favorite. So that's why we sort of don't check that box in this one. There may be some additional benefits tied to them, but so. Permanent life insurance. I'm guessing those watching this might be surprised on all the blue there, but with permanent life insurance, you do get tax deferred growth. You do get tax-free distributions. You will get competitive return, believe it or not. The nice thing about permanent life insurance, you can put as much into it as well. There are some limitations based on the insurer and how much you make, but I guarantee you can put a lot more money into something like this than you could a 401k. So there are high contribution options. There's some collateral. Typically not. There's some hybrid plans we use for certain business owners where you may get that deductibility, but that's a whole nother topic. And collateral opportunities, you can absolutely collateralize your cash value life insurance policy. Absolutely. They are safe. You're not going to go backwards unless you happen to have a variable life policy, which honestly I won't use. I don't believe in them because I think permanent life insurance should be a safe savings vehicle. If you want mutual funds, buy the mutual funds. No loss provisions, absolutely. Guaranteed loan options, absolutely. Every permanent life insurance policy you get out there will have a built-in guaranteed loan option. Now, your loan options become important because that's going to vary from carrier to carrier. Some are guaranteed, they're all guaranteed, but the interest rates are vary with carrier to carrier. So it's an important thing to understand when you're getting into permanent life insurance. And unstructured loan payments, that is the beautiful thing about permanent life insurance is you can take a loan out on a policy and pay it back when you want, if you want. So it's the definition of unstructured loan payments because you don't even have to make the loan payment if you don't want to. And obviously liquidity and control. Not being a qualified plan, because with qualified plans, for instance, IRAs, things like that, you have some severe barriers until you're 59 and a half to those. With cash value life insurance, there are no barriers. Anytime if you need some money from that policy, I recommend loans typically, but you can do withdrawals anytime you want to. So you could be 15, it doesn't matter. So you completely have liquidity and additional benefits. Some permanent life insurance policies have things like long-term care riders, disability riders, critical illness riders. There's all kinds of different, things that'll guarantee you're not going to, a known lapse guaranteed, all kinds of different benefits you can get in a different life insurance contracts. So with the permanent life insurance, you do have more benefits. Now, the downside of permanent life insurance, you have to qualify for it, health and financially, more health than financially. But I always find that interesting. Back in the days when they were underwriting for health insurance, back in those days, I found it easier to get people into life insurance than I could health insurance. I had people I couldn't get on health insurance, but we get them millions of dollars of permanent life insurance. So it really kind of depends. And some of your benefits, like long-term care riders, if you already have some long-term care issues, they may not give you the rider, things like that. But the policy itself, if you're not on death's door, you have a shot at getting it. So there's your permanent life insurance. So those are your major things. Like I said, within all these, there are subsets for different financial vehicles. So you can and if you want to learn more about anything you might have or explore what you can get, go ahead and book a strategy call with me, and we can absolutely talk about this and see what fits your world. Because most of the people I work with actually have a lot of these things. I mean, I don't have a lot of people in CDs and things like that because I find them to be kind of a waste of time money market, or I always call it ATM money. But for the most part, we use all these things where we need them. So if you want to know more about our upcoming schedule, just go to surfcityfinancialgroup.com events. And we're also planning some webinars in the not too distant future. Within the next month, we'll be rolling out some webinars. So feel free to go there and check out the webinars. Yeah, like I said, I'm not a big fan of VUL, but I would be quite okay with whole life. I think whole life's a fine product. UL in certain circumstances, depending how you use it. Now, the key to life insurance is how you fund it in reality. Like I said, I'm personally, I know a lot of people use it. I'm personally not a big fan of VUL for the simple reason I want this to be a safe savings vehicle, and that's why I typically use IUL, UL, and whole life because those are safe savings vehicle. And there's a spectrum there too. I mean, whole life's clearly safe, probably a little safer than IUL, but IUL has much more upside potential. But if you don't have access to it, doesn't matter, does it? So, but yeah, I think there's some really good whole life policies out there as well, and get some good UL. UL I typically will use mostly for death benefit driven purposes. So because they are a little more interest rates and things like that. They'll work, but it's just not compelling. If I was to choose between UL, if I was looking for cash accumulation and having a savings account, between personally as things sit right now, I would go to whole life before I'd go to UL. So hope that answers the question. Anybody else? Any other questions out there? If you do have any going forward, feel free to reach out. And like I said, we're going to be doing this again in another 2 weeks. And like I said, check the schedule. You'll see what's coming up next. It's subject to change, but we're going to try to stay with it, and look forward to getting more out there. So, thank you very much. I hope this was useful, and we will talk soon. Take care. Bye bye.